Good morning. Good morning, everybody. Are you able to hear me now?
Yeah, we can hear you, Suzannah, no problems.
Fabulous. Well, thank you everybody for joining the session this morning. My name's Suzannah Crookes. I'm a director in the People Advisory Services team at EY, and my particular focus area is the incentives and employee share ownership. And that's the topic of our session this morning, looking at different ways in which you can bring the workforce in to share something of the success of a company. The agenda this morning is summarised on this slide. I think we're going to cover three main areas. First of all, taking a step back, when you start to think about a share incentive, what do you want to achieve with that incentive? Why you might be looking at a share incentive, and then some different structures and different ways in which you might implement that incentive. So as we go through the agenda this morning, please do feel free to ask any questions. If you want to click the microphone off and shout up, that's absolutely fine. There's also a Q&A box where you can type questions. I'll try and keep an eye on that during the session, and we can also pick up any questions at the end. So we'll start off thinking about what a company might want to achieve with an incentive. What are the key drivers going to be? I think first of all, companies will often be looking at attracting the top talent. So share incentives are often a key part of a reward package, and that may attract new recruits, that can help to motivate people during their time with the business, and that can help to retain people in the business over the course of its life cycle. It's quite important to have a clear idea at the outset which of those drivers are key motivators in bringing your plan into play, because it may influence the sort of structure you want to adopt to get the most out of that incentive. You may be using the incentive to drive particular performance. So it can be structured around particular targets to drive the behaviours that will help the company to meet those targets. You may be looking to align interests to make sure that your employees have an equity interest in the business so that they're aligned with existing shareholdings. You may also be thinking about tax efficient ways of delivering a reward package to the workforce and cost savings for the business. That's something which is quite topical just at the moment, where a number of businesses are facing cash flow issues or changes, at least in their cash flows due to the pandemic and to lockdown. And some businesses are now looking to share incentives in place of, for example, cash bonuses, where that may help the cash flow situation. A share incentive is quite often used in terms of preparation for an exit event also. So some sort of share incentive where the value is going to be delivered at the time of an exit. And it can be used as part of succession planning as well, which we'll talk a bit more about as we go through. So again, in framing what you want to achieve with the incentive, there are a few key things that should be front of mind when planning the structure. It needs to be aligned with the business strategy. You need to have an incentive where the participants in that incentive are going to be motivated to work in a way that's consistent with the company's business strategy. So if you have any performance targets, they've got to be aligned with a business plan, for example. Incentives should be aligned with a company culture. So we hear more about purpose and culture in today's workforce, and that's very important in a number of businesses. It can really help with engagement as well, which is another topical area. We're having lots of conversations with companies at the moment about how to keep a disparate workforce motivated and productive when people are working in different ways, in different locations, during an uncertain time. A central company culture and being able to communicate that to the workforce is really important, and an incentive scheme that can help to underline that can be really powerful. Turning a bit to the financials, I mentioned cash flow and using share incentives perhaps where there are cash flow constraints. But any sort of incentive has to be affordable. It needs to be funded potentially, and there will be accounting costs as well. So in focusing on strategy and culture and performance, there also needs to be an understanding of the cost of putting all of that into place. Finally, and I think perhaps crucially in getting the most out of your incentive, it's got to be simple enough that the people receiving it and benefiting from it understand it. There's sometimes a bit of a trade-off here. If you've got something that's really closely aligned with business strategy and really carefully tailored, perhaps with a wide combination of different performance targets, sometimes the key message can actually get lost in the detail. So it is really important, as well as to have that element of tailoring, to make sure that it's easy to communicate and transparent for participants to understand what do they need to do to maximise that incentive, should be the key message. So having worked through those various considerations, if you've got a roadmap of what you want to achieve with the incentive, why might you think about a share incentive? Now, some of you might have spotted that this slide looks very similar to a couple of slides back, where I put the key factors for what you might want to achieve. And that's really to illustrate the fact that a share incentive can help you achieve a lot of those key motivators. So, for example, in looking to attract top talent into the business, to recruit those key members of your workforce, you have to bear in mind that their peer groups and where else they might be looking to work, where else they could apply their skills. And in a sector particularly where the market practice is to offer share incentives, equity awards, then it will help you to attract those people. There can be a motivation. So for some, and I don't think this is always the case, but certainly for some, there is a perception that equity is more valuable than cash. There's a potential in equity. If you've got shares, you can benefit in the upside. If you get cash, that's your cash in your pocket today, which in itself is valuable, but you don't have that upside potential. Equity can also be really useful to underline a retention motive. So where you have a workforce who have shares in your business or have an equity interest of some type in the business, that can help engender more of an ownership mindset, which typically tends to be a little bit more of a long-term view of the business, which even without the sort of time period considerations of your incentive itself, can help to retain people in the business, that it engenders a sort of engagement and loyalty that may be different from simply paying a cash reward. So a share incentive can help to drive performance. You will have incentivization to grow the value of the company. If your interest in the company is in its shares, you're going to realise more value if you help that company value to grow. There will certainly be alignment of participant and shareholder interests. If the participants actually own shares, that's clear. But even if they have some other sort of right that is linked to the equity, the same sort of engagement can come through. Shares offer potential tax efficiencies and already, as we've mentioned, cost savings, and clearly work well where your incentive is targeted to an exit where there's going to be a sale of those shares. So really drawing all that together, what are you looking to achieve and how might you do that through shares? There's a sort of cycle here of different questions that you'll want to answer. Having thought of what you're trying to achieve in the first place, how can you bring that to life through a share incentive? And answering these questions will help inform the next section, which is really what is the right structure for your incentive. If we start at the top left, ownership, if it's really important for participants to have an ownership in the business, you will certainly be looking at shares, possibly rights to acquire shares, but that feeling of ownership is going to be important both through the structure and through the communication of what you put in place. With share ownership, of course, comes a degree of risk. We've all seen those disclaimers about share values can fall as well as rise. So what is the risk appetite for the people that you're hoping to incentivise, especially if they're needing to invest something to acquire shares, to pay for those shares up front? Are they willing to accept the risk that they might not get that value back if the business doesn't go in the direction that clearly everyone hopes it will? So what is participants' risk appetite? You don't want to be in a situation where those participants are landed with liabilities or potential liabilities that are actually going to be a disincentive and perhaps demotivating. Quantum is a very obvious question. How much do you want to hand out? It's that dragon's den question. What percentage of your equity are you willing to part with? It doesn't have to be as simple as just a straight percentage of equity, because there are different ways you can structure, whether you're giving a percentage of growth or a percentage of the whole value, or if this is delivered in cash, it might simply be a monetary value. So quantum is clearly a key question. If you are thinking about ownership and actually giving away shares, what percentage ownership is going to be meaningful is another aspect to that question. Timing, perhaps another obvious question. So your participants' first questions are probably going to be on quantum and timing. How much will I get? When will I get it? It works quite nicely with a share incentive if it's linked to an exit event. So the timing may not be certain, but at least the event that triggers the delivery of value will be certain. If there's a sale, potentially if there's an IPO of the business, that's when the value will be realised. But you may also be looking at something that delivers value more frequently, and that will be a key question in terms of what's the appropriate structure. If you're a private company using shares to incentivize people, there's quite a lot of administration if you want to allow those people to realize cash prior to an exit, especially on a regular basis prior to an exit. And so you need to think whether that's really what you want to be doing, or whether actually to drip feed cash at regular intervals over a period of time is better served by having a cash incentive, even if it's linked to share value. So those key participant questions: how much do I get? When do I get it? The next one may be, what do I have to do to secure it? So that's the performance linkage piece. Do you need those participants to achieve certain goals before they're entitled to that reward, before their entitlement vests, for want of a better word? And is that performance linkage down to personal performance? Is it in some way linked to an annual appraisal process? Or is it down to company financial targets or particular milestones? Or it may have no performance linkage other than the achievement of a successful exit. So there's lots of flexibility that can be brought in around performance, and this is where you probably go back to those very first questions about what you're trying to achieve. Are there particular behaviours you're looking to motivate? Are there particular milestones for the business that you need to engage everybody in through the use of this incentive? Pay to play, then, the final box on this slide, links a little bit back to risk appetite, potentially to quantum. Is this incentive purely a reward upside for participants, or do you want them to have some skin in the game? Do you want them to invest some cash in the business, potentially through share acquisition, in order to have the potential for that upside? that's quite an important question too, and not just whether you want the investment, but at what stage you want that. Do you need them to pay that money in upfront, or if that's something, you know, typically with the share option, you'd pay the price when the option vests at the end of the incentive period. So that's another of the key questions, and perhaps another one that plays into the participant question about quantum. And it plays into that question about risk appetite. So actually, if you're not requiring any investment from your participants, there's probably no downside exposure for them. And so it doesn't matter if they're very risk averse. So I think up until now, I've probably been posing quite a lot of questions which form the basis of structuring what the incentive's designed to achieve. We're going to move on and talk a little bit about the incentive structures that can support that, so that we can use to achieve those outcomes. But just wanted to check whether we've got any questions in the meantime. I got a notification from the Q&A box, I think, but can't see any questions in there now.
There's none at the minute, Suzannah. I'll give you a shout if any come through.
Super. Okay. Right, so how should your incentive be implemented? There are lots of variations, but there are broadly, in my view, 3 types of plan. You can have a cash plan. You can dress it up to look like a share plan, but by linking it to the equity value or construing it as a phantom plan or a shadow plan, so that the communications look like equity, but essentially it's a cash bonus and it brings the flexibilities that you have with a cash plan. You can have share options, so that's a right to acquire shares at a point in time in the future, and that's getting a step closer to having an actual equity stake. And then the third category is that actual equity stake, so an upfront acquisition of shares by participants in your incentive plan on day one. I'm going to talk about each of those in turn. So this is an overview slide. There's a fair amount of text on that slide, and rather than taking it all in one chunk, we'll go through and look at each plan type separately. So cash, first of all. The cash incentive can be a very straightforward cash bonus, like an annual bonus. It may be more long term than annually, but it's the same principle. You have a set of clearly defined performance targets which are communicated to participants. If those performance targets are met, or to the extent they're met, then there'll be a cash payment at the predefined time period. Now, you can use a very similar approach through cash to achieve something more like a share plan. So communicate it a little bit like a share plan and linked to the value of the shares, but not giving a participant any actual rights to shares. So what would be the advantages of doing that? I think the main thing is the flexibility. Once you get into shares, you are having to issue shares, and there are some administrative requirements that come with that. With cash, it's completely flexible, so it's easy to implement. You don't have to issue shares or create new classes of shares. It's easy to administer. You know, if somebody leaves and they forfeit their award, you don't have to get shares back off them. Their entitlement to the payment simply falls away. It is very easy to communicate. Everyone understands cash, so long as you're clear around your performance targets and when that cash will be paid. It's all very straightforward, and there's no downside risk. Your employees aren't putting any value in order to get this payment out. However, what cash is not going to achieve is that ownership alignment that you'd have if you were issuing shares. You can go some way towards that by dressing it up, as I've said, as a sort of phantom share plan, but it isn't going to be exactly like giving your participants equity. it does have to be funded as well. So to the extent that cash flow issues are a consideration, is that cash plan going to be affordable for the business? And that's where it's perhaps important to think very carefully about what performance targets you apply to a cash plan. Make sure that those performance targets are going to protect the business, perhaps, such that there's going to, if the performance targets are achieved, you'll be comfortable that there's enough cash in the business to fund those cash payments. Cash is going to be subject to employment taxes, income tax for the participants, and when you're using cash, there's no possibility, certainly in the UK, of getting around that. So cash won't provide any vehicle for tax efficiency, whereas share options and shares potentially can, and we'll look at tax comparing the different types of plans a bit later on. So cash is always a fallback option, if you like, where there's going to be something that prevents the use of shares or share options, but it won't provide that direct alignment with the shareholders. So share options, perhaps the next step towards equity ownership. We've got two types of share options in that box at the top. What is still generally referred to as unapproved share options. There's nothing negative really about being unapproved, other than it means you won't get any sort of a tax advantage. So we've got unapproved share options and we've got tax favoured share options. Commercially, they are the same, the rights to acquire shares when the option is exercised. It may be subject to performance targets, but it doesn't necessarily have to be. Share options will have an exercise price. Commonly, that exercise price is set at the market value of the shares when the option is granted. So a company will say to the participants, shares are worth £1 today. You've got a right to acquire shares, say 3 years down the line, or when an exit occurs, at today's price. So if value increases, the option gain is the difference between the price when you exercise the option and the £1 exercise price that's been established at the date of grant. It's also possible to grant share options, certainly unapproved share options, with an exercise price that is lower than the market value. So if the intention of your incentive is to deliver the whole share value and not just the growth to the participants, then you can set the exercise price at nil or at a nominal amount rather than the current market value. And it just goes back to what you're looking to incentivize, what commercially you're looking to achieve. So where are share options going to be appropriate? Well, they are reasonably flexible. If you're looking at tax favoured share options, then you're going to be looking at a regime that must comply with the relevant tax legislation, and there are going to be a few more limitations around exactly how you can set that up. But aside from that, once you're away from the tax favoured options, they are pretty much completely flexible in terms of when they can be exercised, what the exercise price should be, what happens if somebody leaves, and so on. They're reasonably straightforward to implement. You probably need to do a little bit more in terms of documentation than you would with a cash plan. You would typically establish a share option plan, or at least a suite of option award documentation. So there's a little bit more documentation than would necessarily go with a cash plan. But all you're doing now is granting a right to acquire shares. You're not actually issuing any shares as yet. So it is still quite straightforward to implement. And it's reasonably straightforward to administer as well. So as I mentioned for the cash plan, if, for example, somebody leaves out of your incentive plan and is no longer entitled to that award, then the option can simply fall away. You don't have to do anything further. You can set it up so that the default is that it falls away, and once that individual has left, they no longer have any entitlement. Another advantage of options here is the tax advantage treatment, which we'll talk about in a minute, as I say. And you do have some ownership alignment here. Participants are going to acquire actual shares, So the value of what they get out of their option is directly linked to the equity value. They don't own actual shares, but the value of their entitlement is linked to actual shares. So you're starting to get a lot more alignment with the shareholder position. But with share options, there's no day one investment. So unlike potentially with actual shares, there's not going to be any employee downside risk in terms of actual financial exposure. They may not get any value out of the options at the end of the day if equity value doesn't increase, but they haven't put any money in at day one, so there's no financial downside exposure. What are the cons for share options? Well, there's a little bit more administration required than cash awards, but that shouldn't really be a disincentive to using share options. It's a reasonably well trodden path and reasonably well understood. Companies who don't meet the conditions for tax advantage treatment of options and for whom tax efficiency is a key driver would therefore not want to go down the share option route without first considering whether actual shares might offer a better tax outcome. So I think that certainly a number of the companies that I work with who look at share options, but if tax efficiency is a key driver, and if the conditions for the tax favoured treatment cannot be met by that company for whatever reason, then they would next turn to one of the actual share structures. So we'll move on to those now. So at its simplest, a share award is an issue of shares to the participant in your incentive plan. This could be ordinary shares, so there's complete alignment then between the participants and the existing shareholders. They've got the same class of share. You can impose conditions on their ownership of shares, so you can put restrictions on the share ownership. This is sometimes called reverse vesting, so where a cash award or an option may vest once targets are met. With share ownership, the shares are owned, and then if targets are not met, they're forfeited. So that's sometimes called reverse vesting. And those conditions can be around performance, personal performance or company financial performance, or they can be around employment. So it's not unusual for a leaver, as we've said, to have to forfeit their award. With an acquisition of shares, typically participants will pay the value of the shares going into this award, or to the extent that they don't, they may be subject to a tax charge. So that's a really major consideration where looking at an upfront acquisition of shares. Is this arrangement going to be affordable for the participants? And to the extent that the company wishes to put participants in funds, is it going to be affordable for the company? Now, one structure that companies typically look at when considering an upfront acquisition of shares is a growth share structure. So this differs from a straightforward acquisition of ordinary shares because it will require a new class of share, the growth share, or they're sometimes called hurdle shares, potentially flowering shares as well. So it's a bespoke class of share, usually created specifically for this incentive purpose. And the rights attaching to those shares are usually focused on the future growth in equity value of the business. So typically a growth share will have capital rights that say that the shareholder is entitled to the value in the shares above a predefined hurdle. That hurdle may be set by reference to equity proceeds on an exit, possibly to an IRR target where there's an external investor measuring IRR. And you may have other performance targets applied as well, which could incorporate some element of personal performance. It all depends really on the appetite for complexity in the arrangement. But typically a growth share, as I say, the basic principle is a growth share will deliver just the growth in the value of the business above a predefined hurdle. So growth from the date of acquisition is going to be delivered on those growth shares. They may carry a right to dividends, they may carry voting rights, but very often they don't. They're simply a mechanism to deliver that growth. And when you value a growth share on the date it's acquired, how much does the participant have to pay? What is that share worth? It will typically be a lower value than an ordinary share, because obviously the business is going to have to go through some level of growth before that new class of share carries any value at all. So it's not as simple as saying, well, the value of the business today is, say, 10 million, and these shares don't carry any value unless exit proceeds are above 20. So today that share is worth nothing. HMRC doesn't quite take that view. HMRC's view is if you're using this growth share as an incentive, you clearly think it's worth more to those participants than nothing. Otherwise, it doesn't really represent a true incentive. So HMRC looks at the expectation of any return on those shares. So how likely is it that you will reach that hurdle? How likely is it that these growth shares will deliver value to the participants? That expected return methodology will quite often give an initial value to a growth share, even if it looks to be technically underwater at the time of acquisition. And there the position is similar to that we mentioned for ordinary shares. The participant will either pay that value or will be exposed to a tax charge on the value of the shares if they acquire them for free. So a few more issues to think about up front with an actual share acquisition. So why might you go ahead and do it? Seems a bit more complex. Well, clearly it provides that maximum ownership alignment. Participants in your incentive are going to be actual shareholders, are going to have an actual stake from day one. So where that sort of engagement with an ownership mindset and that alignment with shareholders is an important driver for your incentive, share acquisition is going to be top of the list. Back to the little diagram with the hexagons, we had pay to play in one of those spaces. So share acquisition is the easiest vehicle to use if you want participants to make some sort of upfront investment. If you want a pay to play mechanism, you can require them to pay upfront for the shares. So they've got that investment. That in itself can be a motivating factor for those participants to work to really grow the business, because there's a downside risk for them if they don't. There's a tax upside on the shares compared with unapproved options or cash, which is that growth will generally be within the capital gains tax regime. So currently that's a top rate of CGT on shares of 20%, compared with a top rate of tax at 45% or 46% if you're in Scotland. Actual share ownership can be more easily understood than share options. It can be easier to say to somebody you're acquiring a share than to say you've got a right to a share which you can exercise and acquire that share at a point in time in the future. There's a lot more that goes into the communication, and if you've got complex growth shares with hurdles and performance targets, then that may detract from the simplicity of the communication. But there is something that's very clear about an upfront share ownership which can assist in that ease of understanding. So the cons probably come through the discussion so far. They're more complex to implement. You've got actually to issue shares on day one. You may be having to bring a new class of share into the company's constitution. So that's an amendment to the articles. You may need shareholder consents. Well, you will need shareholder consents if you're updating the articles. There's more complexity of administration. So if participants leave, they are actual shareholders. If you want them to forfeit the shares, you still have to get the shares back off them somehow. So somebody needs to buy those shares, or the company needs to buy them back. And there's a bit of administration that goes with that, especially if you want to give a good leaver some degree of value when they sell their shares, that will also have to be funded at the time. So there's a bit more administration during the life of the incentive plan if you're using actual shares. Employee downside risk we've mentioned, and so generally I think, as you'll see, there's less flexibility than the other structures if you're using actual shares, and that's really because of that equity acquisition up front and owning the asset from day one. Nevertheless, a carefully crafted class of growth shares can be remarkably flexible in terms of delivering the sort of incentive that you may wish to deliver, and so is always should always be on the menu of options, even with that complexity around it. Now, I've touched on the tax treatment as we've been talking through and just summarised it here on this slide. So essentially, I think tax treatment falls broadly into two categories. Cash plans and unapproved share options will be subject to income tax and NIC's national insurance contributions when either the cash is paid or when the shares are delivered when a share option is exercised. So the whole of the value that comes out of the incentive will be subject to income tax and NICs, and that income tax will be at the individual's top marginal rate. Bear in mind, if you've got a very generous incentive, you might push somebody into the next tax bracket up. So we can typically be looking at those top rates of income tax with national insurance on top as well. But that's just a given, and actually it shouldn't be the tax treatment always that's the driver of the incentive. The commercial outcome should really be the number one consideration. Having said that, if a more tax favoured route is available, then it is definitely worth considering. As I say, the differential at the moment is between 20% capital gains tax and 45% income tax with national insurance on top. So that makes quite a difference, and in itself can really enhance the value of the incentive that you're putting in place. There are a variety of tax favoured share plans established by the tax legislation, which I'm going to summarise on the next slide. But I think for SMEs, the enterprise management incentive is probably the most frequently used, and based on HMRC statistics, it is still the fastest growing tax favoured share plan that we use in the UK. It is remarkably generous, and we'll talk about some of the conditions briefly in a minute, but essentially the growth in value of the shares will be subject to capital gains tax when the option shares are sold. So the individual exercises the EMI option, acquires shares, there's no tax at that point, but when the shares are sold, there'll be capital gains tax broadly on the difference between the exercise price paid and the value of the shares when they're sold. The icing on the cake with EMI is that potentially participants can also get entrepreneurs relief if at least 2 years have passed between the grant of the option and the sale of the shares, provided they remain in employment and the company is still trading. And that reduces the CGT rate further to 10% on the first million of lifetime gains. So you can be looking at a differential of between 10% and 47% tax and NICs when comparing EMI with unapproved share options or cash. On share acquisition, there are a few more ifs and buts and it depends points around the tax treatment. But essentially, there are two tax points to think about. So with cash and options, you're looking at tax on payment and tax on delivery of shares. With share acquisition, you've got the two tax points potentially. You've got tax when the shares are acquired, and you've got tax when the shares vest or are sold. So when the shares are delivered, if they're acquired for free, or if the participant pays less than the market value of the shares on acquisition, there will be income tax on the value that the individual acquires at that point. So if your shares are worth £5, the individual pays nothing. They've got income tax on £5. If they pay £2, they've got income tax on £3. Just it's on that discount amount. That may be self-assessment tax, it may be PAYE if there's any sort of a trading arrangement for the shares, or if the company is not an independent company. And where there's PAYE, there will also be national insurance. So there's a particular question about how to fund that tax charge on acquisition of the shares, because there's no cash being passed over at that point. So the participant might have to dig into their own pocket to fund that tax. Or companies sometimes consider lending money to participants, either to acquire the shares or to fund the tax charge, with that loan being repaid at the end of the incentive period out of the proceeds of sale of the shares. So in that way, the participants do pay for their shares, but they're not required to make an upfront investment where that might be unattractive. As always with shares, there's some level of risk around that. If in fact the proceeds of sale aren't sufficient to cover the loan, then there's an exposure for the participant at that point. Even if the company writes off the loan, there's going to be a tax exposure. So there are some ifs and buts to be worked through. There are some additional tax impacts of the funding arrangements itself, but there are alternatives to think about when structuring that. So that's the initial tax point when shares are acquired. If shares are restricted, there's a specific UK tax regime for restricted securities, which is essentially a set of anti-avoidance provisions. And what it's seeking to address is a situation where you might have a class of share and apply numerous restrictions to reduce the value of those shares. That makes the share acquisition more affordable for a participant. But then you could simply release the restrictions, the value shoots up, and in HMRC's view, then that individual is acquiring value that ought to have been subject to tax. And so what the restricted securities regime does is say, well, if you have restrictions on day one and you pay based on a restricted value, then once you remove those restrictions, or if you vary those restrictions, or if they fall away when you sell the shares, then the value enhancement falls within income tax at that point. Now, that's typically not what people are going to want. Actually, what people want is to acquire shares and to have growth within capital gains tax. So there is a mechanism to elect out of the restricted securities tax regime. That might mean that the initial value of the shares, which no longer takes into account the restrictions, is slightly higher. So there may be a slightly higher cost to pay when the shares are acquired. But the advantage of doing that is that all of your growth in value will then fall within capital gains tax, subject to any other anti-avoidance provisions. But that is very commonly the approach that companies will take in structuring, for example, a growth share plan. Because typically, if value increases, it's overall going to be a better tax outcome to suffer a little bit more income tax at the beginning, but have all of that gain within capital gains tax. So a few more things to think about with share acquisition. As I say, there's a lot more complexity on a variety of levels with the acquisition of shares, but the two really big advantages of going down an actual share plan are that complete alignment with shareholder interests and this potential for capital gains tax treatment, which you can only otherwise get on share options if you meet all of the conditions. So just to say a bit more about those tax advantaged share option schemes. Set out on this slide the four types of plan that are provided for in the tax legislation. EMI and CSOP, which is the company share option plan, are discretionary plans. So you can, if you set up one of those plans, you can choose who participates in it. SAYE and SIP, so that's Save As You Earn plan, and the Share Incentive plan are all employee plans, and you have to offer those to all of your UK workforce if you bring those in. I won't say very much about those two plan types now, but they are less common in SMEs because usually EMI and potentially CSOP will be easier to operate, and actually you can choose to offer those discretionary plans to everybody in any event. So EMI, I think, is the first choice for any company looking to bring in a share plan. If you can qualify for EMI, this is going to get you the best potential tax treatment within the financial limits. It's specifically aimed at SMEs, and the intention is to allow them to recruit and retain key talent. So it's trying to support companies in offering a very tax advantageous incentive and allowing those employees to share in the success of a fast growing business. The quid pro quo is the qualifying conditions that are attached. So the company must be independent. If your company has a 51% or more corporate shareholder, then EMI won't be available. But provided you're an independent company, you then got a number of qualifying conditions to work through. The most well, the sort of headline conditions, I suppose, are the gross assets test. So the gross assets must be less than 30 million, and the employer numbers. So the business must have fewer than 250 employees. That's measured on a full-time equivalent basis. There are a number of other conditions as well. There are some particular types of trade that are excluded. And there are some conditions for the employee as well. So your employee must be working at least 25 hours a week for the business, or if they're part-time, it must be at least 75% of their total working time. So there's a checklist really of qualifying criteria to work through. If you meet all of those qualifying conditions, you can then consider an EMI plan. You can only grant EMI options as a company in aggregate over £3 million worth of shares. So if your share capital has quite a high existing inherent value, that may be a limitation. But very often the 3 million value, because it's measured at the date of grant, and because in agreeing a value, which you can agree in advance with HMRC will often agree a discount to the headline equity value. That 3 million is often generous enough to do quite a lot within the scope of the EMI plan to incentivise the workforce. There is a £250,000 limitation per employee, so each individual can only be holding EMI options over shares worth that 250,000. That's measured again at the date of grant. So that sometimes does put a cap on EMI, but it's often possible to get quite a lot of the incentive within that financial limit. So if you ticked all the boxes, all the qualifying conditions, and you can grant within those financial limits, then you have a very tax advantageous share option. Any gain in value above the market value of the shares when the option was granted will be within capital gains tax. And as I mentioned before, entrepreneurs relief may also be available. So that would give a 10% rate of tax on gains up to £1 million. EMI is also very flexible compared with the other tax advantaged plans. So although that tax advantageous treatment only applies on the gain above market value at the date of grant, you can grant the options at a discount. So you can grant EMI options with a nominal exercise price, but any amount of the discount to that market value when granted will fall within income tax. So you just don't get the tax advantage on that discount amount, but commercially you can still deliver the full value of the shares if that's what you're aiming to do. EMI is also very flexible around when you can exercise the options. So long as you've got that clearly set out in the contract that grants the option, you can have those exercised at different periods in time, at an exit, when particular milestones are hit. There's a lot of flexibility that can be achieved with EMI. However, some companies won't qualify, won't be able to grant EMI options. And then it is worth considering the CSOP. I think often companies that can't qualify for EMI will actually look at something else like growth shares. But sometimes the CSOP provides an alternative for companies that don't want to offer upfront share ownership but are very keen to bring in a tax favoured option. Essentially, the CSOP is a little bit like EMI insofar as it's a share option plan. It delivers tax advantages on the growth in value of the shares. So for the CSOP, your exercise price must be at least equal to market value. You can't have a discount as you can with EMI. Above that market value, the gain in value when you sell the option shares will be within capital gains tax rather than income tax. You're unlikely to get entrepreneurs relief with a CSOP unless you've got a large existing shareholding outside the plan. So not quite as generous as EMI. The financial limits are much lower as well. So rather than 250,000 per employee, it's only 30,000 per employee. But still, for some businesses, that is ample to deliver the sort of incentive that they want to do. It is overall less flexible than EMI. The tax advantages are only available if the option is exercised more than 3 years from its grant date. Generally, there are some exceptions for good levers and some types of corporate transaction, but it's much less flexible. But it's still worth considering. The qualifying conditions for EMI don't apply for CSOP. There are some criteria about the type of share capital that you're issuing, but generally it's going to be easier to meet the CSOP criteria than those EMI qualifying conditions. So just very briefly on the two all-employee plans, I'm not going to say a lot about these. They're less likely to be attractive to SMEs because they involve quite a lot of administration, usually operated with a third-party provider, and therefore there's quite a lot of cost. And you can probably achieve what you want to achieve through EMI or CSOP if you're looking at giving something to the workforce as a whole. Save as you earn is a share option plan that works alongside a monthly saving into a savings contract. Savings are built up over 3 or 5 years, and then the savings are withdrawn and used to pay the exercise price on a share option. So the participants can exercise their options and acquire shares. The exercise price is set at the date of grant, as you might expect. It can be discounted by up to 20%. And all of the gains are then within capital gains tax. So SAYE is very popular in UK listed companies. It's widely used, and we periodically see headlines in the press about high-profile household names whose employees have had a windfall out of SAYE plans, for example. Share incentive plan, another all-employee plan. It's a little bit different from SAYE because it involves actual share acquisition. The big advantage of SIP is the contributions to acquire shares, where the shares are purchased, are made out of pre-tax salary. So you're a step ahead in terms of tax treatment from day one in terms of acquiring those shares. Companies can match share acquisition, can also award free shares if they want to, and dividends on SIP shares can be reinvested tax-free into more SIP shares. So a SIP it's perceived as having some additional risk over an SAYE because there is share acquisition on day one, and if share values fall, you suffer that fall in value. But the sort of cushion that is provided by the very advantageous tax treatment goes a long way to addressing that. It is quite a flexible and potentially quite a generous plan, but it's a bit more complex. You need a trust. You will generally look to a third-party administrator to help operating the SIP, so it's a bit more costly to bring in, but I've mentioned it there just for completeness. Now I think we're coming up a little bit against the clock now, but this final slide just outlines some alternative structures which I think we can rattle through quite quickly. There's not much more to say. Restricted stock units are another type of share option, essentially. It's a right to acquire shares, but there's no exercise process. Some companies prefer that from an administrative point of view. Restricted stock, we've talked about essentially. It's an upfront share acquisition where restrictions apply. So it's a little bit like a growth share. Sometimes companies use that terminology where the tax charge occurs at vesting. rather than on acquisition. But I think typically you'd see that sort of structure more often in a listed company LTIP, whereas a private company might look more towards a growth share structure. Employee benefit trust can be regarded as a share plan in itself, but what it usually is doing is working alongside one of the other award types that we've already talked about. The employee benefit trust is set up as a particular type of trust which can be useful to aid the administration of a share option or share acquisition plan, because you can park shares in an EBT. There are some tax, I wouldn't say tax benefits, but an EBT doesn't fall within some of the more restrictive provisions that might apply to other types of discretionary trust. So it's a good way to warehouse shares or to provide an internal market if you are offering actual share awards, and where you might have leavers or new joiners. Those shares can come in and out of the EBT and create that sort of internal market. Jointly owned shares are really another way to achieve the same commercial outcome for the participant as a growth share. So rather than acquiring a new class of share that gives rights to growth above a hurdle, a participant acquires an interest in an existing share jointly with a co-owner, which is usually an EBT trustee, and the participant gets the growth above a hurdle. The EBT retains the inherent value. It's quite useful if a company has some difficulty in creating a new class of share, for example, which is, sometimes if investor consents would not be forthcoming, or if it would upset a complex waterfall of existing share rights, then jointly owned shares provide an alternative. And finally here, the employee ownership trust is something some of you may have heard of, come across. It's a specific tax advantaged vehicle, which was established following a review by the Office of Tax Simplification into ways to support employee ownership. And it allows, through the employee ownership trust, a workforce to take ownership of a business. It's usually used as part of succession planning for owner-managed businesses, where the business owner, the founder, wishes to exit the business potentially, but doesn't want necessarily to go through a trade sale or a private equity sale, but can sell to the workforce, can sell to the employee ownership trust, and there is some capital gains tax advantage for the business owner in doing that. The employee ownership trust then offers some further tax advantages to the workforce. It can pay out cash bonuses subject to an annual limit with some tax advantages. So that is one, if the purpose of looking at employee share ownership is part of succession planning, the employee ownership trust should definitely there be on the list of alternatives to consider. So I think I'm actually just a couple of minutes over time, but I'm happy if anyone has any questions to discuss them now, or you've got my contact details there if you'd like to follow up separately. I'd be very happy to answer any questions.
There are some questions in the Q&A for you, Suzannah.
Okay, now if I can, what I've lost is my little link to Teams now. So
if you stop sharing your screen, it should come up.
Here we are. So can the slides be made available? I think that is fine. Catherine, I can perhaps share them with you after the session.
Perfect, I'll send them round.
So how do you normally go about valuation of a growth share? It is a very good question. I think if share value is low, EMI is going to be easier to implement because there's a well-trodden path to get the value agreed with HMRC up front. You can't agree a growth share valuation with HMRC specifically. So if if you can qualify for EMI, it is another advantage of EMI actually that you can get that value agreed initially with HMRC. I'm not a valuation specialist. I work closely with my colleagues in our valuations team where we're helping companies with growth shares. And I think there are a number of different factors that go into valuing those shares, which may depend on the type of business and the appropriate, the most appropriate way to approach that. HMRC, you're absolutely right, do look at forecasts more for growth shares. It is typically an expected return methodology, so it is looking at projections, at forecasts. I know my colleagues spend a lot of time looking at business plans and forecasts and similar data for other companies in the sector, and just trying to project and form a view on what is the likelihood of meeting that hurdle and what the level of return might be above that. So I think valuation professionals will have a methodology that they apply to value those. At the moment, it's particularly difficult. The sort of multiples that you might be looking at and appropriate levels of discounting for various factors, it is all very much more up in the air with the economic situation around the pandemic. So I think it's a lot more complex at the moment, but it can be done. It involves quite a lot of working together, I think, between the valuation professional and the company. And we do tend to recommend some sort of professional advice around valuation because that can protect in the event of an audit by HMRC in future around the tax treatment. I mean, one way you mentioned in the question about building in a buffer, that is a way I have seen some companies run repeat exercises. So they might take some valuation advice on the first grant of growth shares, and then if they're granting further shares in future, the company may deal with a valuation internally by recreating the same sort of methodology and applying a bit extra on setting that hurdle to try and protect against any challenge on the initial valuation. Obviously, the higher you push the hurdle, generally the lower the initial valuation will be. So it's a good question. It's not an entirely straightforward answer. But I think that the point about EMI being better if the company qualifies, it has certainly got some merit. Now I've lost Teams again. Where are we? Any guidance upon establishing and evidencing the market value? Yeah, I mean, I think that's possibly a similar question. Without incurring large fees to do so, that is a challenge, and valuation work is specialist and it doesn't incur a fee. So I think the recommendation is, where there is some flexibility to invest a little bit of cost in getting a professional steer on valuation, at least for a first time exercise, I would recommend that, and that can create a baseline then for taking things forward and perhaps not needing to incur those fees every time, but it does establish a baseline, and which helps not only actually with an HMRC investigation, but it helps a lot on an exit event. So if your exit is a sale of the company, a purchaser carrying out due diligence will inevitably ask about management incentives and management shares, and one of the questions they will look at is, were those shares acquired at market value, or is there a historic tax exposure, or in fact is there a sort of post-acquisition tax exposure which could come to bite at the time of the transaction. So it's very helpful in an exit context to be able to say, well, we took this valuation advice. Some companies will have individuals within the management team, finance director typically, who has some sort of background that enables them to reach a reasonable, to take a reasonable approach in valuing the shares internally, and where cost is where the cost of professional advice is prohibitive, that is another way to go. I think with EMI shares, is there a standardised way of valuing the company or shares? I think it depends on the share. Well, I mean, it depends on a number of factors. But if you're looking at ordinary shares, then I think typically for EMI, you would take the company's view of equity value and then apply discounting for those minority interests, and HMRC is often reasonably generous. So if your EMI population are going to be holding between them only say 5% of the shares, HMRC would typically apply quite a generous discount from the whole company equity value in agreeing a value for EMI. But that in itself will depend, you know, on the inputs that have gone into forming that initial company valuation. I think there's a great deal of comfort through being able to agree that with HMRC, provided you make full disclosure to them, and there is a form that has a list of the sort of attachments that they want to see with it. So you have to submit a few different pieces of supporting information, but in that context then HMRC can weigh it up, and once you have their confirmation of value, if you're confident you've made a full disclosure, then that is the comfort and the protection that you don't have with growth shares, for example. I'm hoping that's covered all of the questions. And I know we're 10 minutes or so over now, so thank you all very much for staying on the line and attending the presentation. As I say, any further questions that you want to send through by way of follow-up, that's absolutely fine, and I hope that's been helpful.